Eric, I want to start with you and just the different signals that we're seeing in oil versus in equity markets. And I'm talking, well, let's focus on US equity markets for now, and then we can sort of broaden this out a little later. In US equity markets, it seemed like traders have looked past this conflict for months. The oil market, not so much. Yes, we're seeing some signs of easing today, but oil is still very elevated. How do you explain sort of the different reactions?
The stock market is moving on growth expectations and the idea that whatever inflation is, it's not showing up in earnings. So right now, you have this incredibly strong economy, remarkably resilient. And although we can see the risks out there, you can see that oil is high. I mean, look, if oil's above 90, that's just not good. You can hear the sounds of, people talking about inflation, and you can see the consumer sentiment, but it's not showing up in earnings. So how do you price these things? And if the belief is that we will get past this conflict and that things will get back to us just discussing, can OpenAI make all of its payments, then we're actually on solid footing and the market can keep going. And if you think about it, it hasn't been as strong as it was in the 2 prior years. So there is actually room to pick up, although this second quarter has been pretty wild.
But Sarah, is this optimism, is it realistic or is it delusional? It's feeling a little bit like Lucy in the football with this Iran deal. It's like, it's going to be there, it's going to be there, it's going to be there, it's not going to be there. Like I was saying earlier at the top of the show, I need them to phone a friend and have them talk to the policy wonks who are saying, you heard Kendall talk about just those few 6 or 7 or 8 or 9 outlying issues that have yet to be resolved. Even if it does get resolved, it's not like this is a tap they're turning on tomorrow. I am new to the market side of this, but I am consistently confounded by what we're seeing in the markets versus what I'm seeing on the reporting end of this.
Well, and I think that we also have the unfortunate experience of having recently gone through this big problem with rates are going up too fast or going down too fast. It's going to have this big effect. It's not going to have effect. Oil is different, but it's not acting differently right now because it is impacted by a lot of the discussions and the fact that there were cushions in both storage and there were cushions. Right? So there was room there. It's molecules, though, and it's not as much sentiment change. And so I do think that there is a wall at which we get to a point where this becomes much more impactful. And to your point, then, it starts to impact earnings. And right now it hasn't been. And the concern is that when it does start impacting earnings, what does that do for the whole earnings trajectory? Right now, the growth of earnings is on the back of the tech stocks. The oil price isn't the biggest problem for them. The memory price is a bigger problem for them. The discussion about token prices and about are you using these efficiently, that's a much bigger problem.
I love that conversation.
But I think that's what's happening right now. And I think it's part of the problem today.
The memory part of this and memory prices are a problem for some tech companies, but for other companies like Micron and SK Hynix, it's actually
good news.
Great news. I mean, both of those companies now surpassing $1 trillion in market cap. Eric, we're going to get to you in a second because you're shaking your head here. But Sarah, I'm wondering just about signs of exuberance with a couple new entrants in the trillion market cap range.
Well, I think that's an issue. I think that's either going to be one of those things that fuels it further or that makes people scared, and we don't know which way that's going to go yet. I would also say that memory has been treated as a commodity. Now the discussion is it's not a commodity because there's no way you can make enough of it. I'm skeptical that something that was a commodity is now decommoditized. So I think that's a little bit of a question for me.
Eric, jump in on SK Hynix and Micron.
Well, it's the whole SOX. It's the whole chip
SOX
complex.
is up 80% this year.
The SOX is up 66% in the second quarter. It's on pace for its best quarter since the first quarter of 2020. I mean, you're looking at the market leaders, and it's Intel, Micron, SanDisk, AMD. I mean, these are, one of them would normally pop up, but that all of them are doing this, there's definitely a shortage in memory. There's definitely a shortage in chips, and the AI money is flowing toward them. The idea that this is sustainable, I mean, we're looking at Micron's valuation, and it's actually really cheap. It's below $10, it's below 10 times projected earnings over the next 12 months. That is incredibly cheap. Like NVIDIA is like at 22, and yet there is concern that this means that we're actually at the peak of the earnings cycle for them. So you don't know where this is going to go, but there's a Chuck Prince kind of dance while the music's playing vibe going on in the market right now. And it's really hard to get in front of this kind of momentum. It just is.
I want to ask you guys about something we made reference to, and that's whether or not the markets are being more particular about AI and software companies and who they're choosing as to be efficient and who they're choosing to be maybe less efficient, whose earnings have not met markets, because we're seeing some of these big corporations start to scale back where they're using these AI tokens, right? Microsoft is saying we're not doing this anymore. Uber has said they're like looking at the value of it, and then there are these stories from several companies saying they're hiring actual humans to do basic coding because it's cheaper than using the AI token. Where does that start to meet the rubber and the road when you look at these huge valuations that we're just talking about? Sarah, you want to take it?
I think that is one of the biggest questions that the market's going to have, and I think that anything that starts to make it look like maybe we're backing off on this is not great, because the idea is it's going to keep growing and we don't know yet. But all of a sudden people are starting to question already whether or not they're getting a return on that and whether or not it's better off to use people. Then this slows that down. Now ultimately that might be better for everything as a whole, but where the market sits right now, it makes it quite vulnerable, I would say, in the tech side.
What we're hearing from strategists is that a lot of this sell-off, while maybe justified, was really broad-based and went a bit too far on a bunch of different names. So the idea, like say you were saying Microsoft, the idea that Microsoft is going to be put out of business by AI or anything like that, it's more likely that it's going to be, Microsoft powered by Anthropic or whatever.
Right.
There are
their huge investment in OpenAI.
Yeah. I mean, one way or another, they're coming into the fold. There are going to be aspects of the software industry that are going to be disrupted, no doubt. But the idea that like you just sell, because at one point we were looking at it as a broad trade of short software, go long chips. That is really simplistic thinking. It works when everything is moving in the right direction, but it can blow up fast. And it's not really based on what the fundamentals are showing. And that's really where eventually this will all shake out. Not now, but eventually.
On the software side, we'll get an update after the bell today. Salesforce is set to report. They've been getting just beat up this year. Snowflake also set to report just after the bell. So we'll bring those numbers to you guys as we do get them. On this question about sort of when this party ends, what does that look like? And are we, there's some people out there right now who are drawing parallels to like the late 1990s, not just because the Knicks are winning, but
it's been a long time, Tim.
It has, but also about what tech stocks are doing right now.
Well, I think that part of the problem with that parallel is just that there is a bigger earnings push behind this, because right now you can have the argument about some of the circular financing in the hardware and who's buying chips and who's putting money into the AI guys, but it's not as bad as it was in 2000 when you had a lot of vendor financing and you had a lot of things that just didn't make sense on their face. And in retrospect, that's much easier to see. And in retrospect, there might be places here, but I think that there really is a sea change here and a major change in both technology and the way we're using it. And for the folks on the software side that are going to have more problems, those are the companies that had a lot of growth in seats. And you don't necessarily need as many seats if you're using some of this, but I think it's
You're saying because they sell by the seat.
Because they sell by the seat, right? So this is an and not an or. And the question is going to be who does the best at that? But the people who had straight up growth that were just piling in more people, that's a little trickier right now.
Eric, is Zscaler a good example of that? I mean, we were looking at them earlier, down when I looked this morning at 28% Wednesday after this fourth quarter not meeting expectations. What did they do wrong and what can other people learn from?
Well, but as far as Zscaler is concerned, they are actually in a position where they could be disrupted by AI, and they're starting to show signs of weakness towards it. What you referred to Salesforce. So a company like Salesforce is deeply embedded in your system. It's really hard to get them out. You're also relying upon their data, their proprietary stuff. If you're just sort of a node that gets attached, or you sell something that is a product that can be copied or redone in-house. So like that's where they talk about, like all the strategists that we're talking to are like, you need to thin slice this. You need to look within the group at which companies are actually positioned to survive this and which are sort of free riding. And Zscaler kind of got caught up. There will be others like that, but there are a bunch that are deeply embedded in their customer ecosystems, and getting that out of there is probably going to be harder to do than just sort of augmenting along with them.
Sarah, I want to just give you the last word here, 20 seconds. What sectors do you want to avoid right now?
I think you need to look at valuation, because I think that there's some places where if you want to play that momentum trade and you're really good at that, then you can chase some of that. But some of the valuations have gotten really out of whack. I also think that you want to look on the plus side at companies where you've got decent cash flow and good, you can understand what's happening there, and some good, capital return.